This is Stockwatch, and with me, Simon Brown, joining to unpack your stock-related questions today. Rowan Williams from Nitrogen Fund Managers, Devin Shutte of the Robert Group. Remember, send your questions through. Email stockwatch@bdtv.co.za, SMS 41392, or on Twitter @BusinessDayTV using hashtag Stockwatch. Gents, thanks for joining us. Devin, let's start with you. You're in studio. More all-time highs from our JSE. This market is strong.
It is strong. We've got a rand at the strongest level it's been this year as well, and really kind of defying investor expectations. You know, if you'd gone away the last 6 weeks, you would have missed all of the chaos we've had to endure, and you would have thought things were just great. So yeah, there are some dynamics kind of driving our local market, but it's really fantastic to see when last year kind of the US large cap equity, the S&P 500 was the only game in town, and now we're really starting to see, I would say, that market broaden out, and our little tip of Africa definitely getting its time in the sun.
Rowan, it is, I mean, a lot of folks, it was all Mag 7, but I suppose we kind of remembering that markets are about that old boring diversification, and a bit of JSE is serving us all great.
Yeah, certainly. I think it did appear that it was a sort of one game in town, but as global macro events have unfolded, that sort of changed the landscape quite significantly. And you mentioned the JSE. It's interesting. The JSE itself is quite diversified, and I think that's what we're starting to see. Gold has done particularly well. Platinum's recently also picking up. And that part of the market has performed particularly well this year, and maybe made up for some of the sort of softness in other areas. So the JSE itself is quite a nice diversified equity asset base to have in your portfolio. So it's serving investors well for the moment.
Rowan, you mentioned platinum there. Questions coming through. We've got platinum and palladium both above 1,000. Are platinum stocks at this point something you're looking at, or is it still a bit of a wait and see?
Yeah, it's quite a divisive sort of asset class, and a very volatile group of shares. So certainly the sort of narrative to platinum has improved. There's sort of expectations or optimism around Chinese demand around jewelry, I guess partly driven off how expensive gold has become. And that's sort of been the latest driver. We just find it quite a complex environment, although there are pockets of value, and I mentioned African rainbow minerals in the past. So we're looking for safer ways to play the theme where you may be getting in at a discount. I mean, people would consider the shares very lowly valued, but we're sort of looking for a margin of safety. So it is interesting, but try and manage the volatility as you get exposure to the broader miners there.
Yeah, and that African rainbow is the Harmony exposure. Your platinum miners?
Look, single stock commodity producers are tough at the best of times, and if you look at gold and platinum, those are on the end of the spectrum. Look, the debate in platinum miners on how long EVs are going to take to really reach full-scale adoption is the contentious issue there. I think there was a lot of above-ground stock that what we hear is starting to be used up. So I think supply is starting to become a lot tighter, and I think you're seeing some of these stocks run. But it's the platinum space is a lot more uneven than maybe the gold counters, who kind of all moved up in unison. I mean, Impala's run particularly well. Amplats, I know there's corporate action there, but then you look at Sibanye-Stillwater, which kind of straddles both, and they really have lagged a lot. So it's a tough old space. It's something we look at from time to time, but we're definitely not betting the farm on it at this stage.
Yeah, it absolutely is. And the platinum's supposed to be in deficit, but to your point, there's stockpiles. And we saw it with palladium and the Russia invasion, lots of stockpiles. We need to work through that. Devin, let's stay with you a second. Pick and Pay results out today. A horror number on the surface, but with respect to them, moving in the right direction, talking around break even by 2028. We mustn't forget they've got cash in their balance sheet now. They've got the Boxer holding. Your take on the results, your take on Pick and Pay as an investment option?
Simon, so the direction, the right one, as you correctly said. I think it's a bit disappointing that the move to profitability has been pushed out another year. Hence the reason Sean Summers is still staying on there. I think that the franchise as a whole has really got a lot of some deep introspection to do. I think the amount of market share they've lost to competitors is going to be very difficult to entice those customers back. I've no doubt that's what's keeping Sean awake at night, and I really hope they do get it right. I mean, it's a fond kind of retail partner that many of us remember, but they've just fallen behind the curve. They haven't invested enough in the business, whereas the likes of Shoprite have poured massive amounts into tech and R&D and that type of thing. So I think they got a fighting chance, but I don't think it's going to be easy from here, and I think really a long climb back to where they were.
Rowan, your take on Pick n Pay, as Devin says, I mean, there's a long way back, and of course every day that they're trying to catch Shoprite is trying to get still further ahead. Would you be looking at Pick n Pay as a potential investment?
Yeah, so it's definitely a work in progress, and what you typically see with these turnaround type of situations, the share price can be quite volatile as different investors have different views of, I guess, the amount of cash burn and how long it's going to take to return to profitability, and if, in fact, they ever will. So the presentation this morning was very credible. I think the management team understand the issues. They see the significance of the challenge, and they seem to be up to it. So that is very positive. I think even though it may take a bit longer to get to a turnaround in terms of profitability or break even, that's being realistic and sort of admitting the scale of the issues that they need to address. And I think if they go back to their core, sort of understand what their key customer is, what they're solving for, and meeting those customers' need, they will continue to have relevance. So we do like Boxer. We think Pick n Pay has been a good way to play Boxer, and it may have moved up a little bit recently, but it's still, I think, an interesting opportunity, and you get some optionality by investing in the Pick n Pay group and the potential for the turnaround.
Rowan, let's stay with you a sec. British American Tobacco question coming through. I've held it for many a year. I've enjoyed the sterling dividends, but the share is looking at 800 Rand. Worried about the future of combustibles. Should I be looking to take profits at these levels? Rowan, would you be getting out of British American Tobacco? If you were in, is this one you stay away from, or do you think there's potential here?
Yeah, so the share certainly has done well recently, and the viewers sort of really pegged what the issues are, converting from combustibles to the non-combustible products, and they've taken a little bit slower and longer than some of the other groups, which moved quite quickly. And I think relative to that conversion of their business, the share's quite fairly valued, and sort of the risks are balanced. So I would agree and would take some profit here and recycle it into other promising counters, which there are a number of, I think, particularly SA Inc., as Devin was sort of alluding to earlier. There's still a lot of value there, and nice businesses, nice opportunities. So it would just re-diversify the portfolio back into South Africa, which I think would be useful.
Devin, British American Tobacco?
Not one that is particularly exciting for me. I mean, obviously that dividend yield is terrific, a lot more tax efficient than money in the bank. But yeah, I mean, I think that transition to non-combustibles is in process. So kind of that strategy is playing out. I'm not too sure what the future looks like 10, 20 years out for a business like this. I think regulatory risk on the old products and the new non-combustibles is a massive risk to them. And yeah, my sense is there's more exciting places to invest. It's not expensive, but I don't think you're going to get runaway total returns on this. So looking elsewhere.
Yeah, I'd say nice dividend, but I mean, look, you've done great in the share, but that's the exception, not the rule. Glencore, question coming through. Looking for copper exposure. There's some juniors on the JSE. Is Glencore a fair-looking alternative?
I think so. I mean, copper is a great place to be looking at the moment. We know what a green metal it is and how that future demand is just off the charts relative to current supply. The management has proved themselves to be savvy. They had a wobble a few years ago, restructured the business, and really well positioned now, kind of always at the forefront of the meta trends that are happening in the commodity space. So yes, I think it's a great way to play the theme, and one we are looking at.
Rowan, would you be looking at Glencore for some copper exposure?
Yeah, it certainly has got a lot of that. The share's been quite disappointing and has underperformed, so that makes it an interesting entry point here. And I think they are in the sort of the right commodities. Obviously, the coal exposure's weighed quite considerably on them. The other one that would be interesting for copper is, in fact, Anglo American. They are unbundling a big portion of the Angplatz stake and becoming more sort of a pure play bulk commodities producer. And copper is going to play a big role in that. So they become more interesting, and I think that's what they're looking to do to improve the rating. So we quite like the Anglo story and the refocusing there. So that may be just a more straightforward way to play the copper theme.
Yeah, and that unbundling, throwing out or unbundling of, demerger, that's the word,
Yes.
is this Friday, if memory serves. Rowan, next day with you. Altron, good numbers. I mean, it's seldom that you read through a set of results and just think, yo, these guys are just doing stuff, and they really are, and have been for a while. Your take on the results, your take on the investment case for Altron?
Yeah, it's certainly been remarkable. The new management team under Werner Kapp, they've done a fantastic job. I think those assets always had a lot of potential. They were just not being fully realized. And what the new management team has come is extracted the value, the latent value. If you look at Netstar and the number of new users, the revenue growth there, the margins they're able to achieve in the services businesses as well, he's sort of taking the portfolio one by one and maximizing the potential and the returns. And what you're seeing is significant earnings growth, improving margins, some turnaround in some operations as well, the document solutions business that they ended up keeping. And so it's turning out to be a really exciting investment story, taken many years, but the ultimate value that's been unlocked from the Altron Group has been substantial.
Yeah, and you, of course, got bites, some 4 odd years ago. Devin, Altron?
Yeah, not bad. Commendable results there. I think the margin expansion was really nice to see. I think they specifically target margins in the platform business, as in the IT services business, which is great, particularly the services segment, which is so competitive. They've been good at defending that, decent dividend coming through and growing there as well. So yeah, very, very little to criticize about, and actually one that's been off my radar for a bit, but yeah, front and center again. And
yeah, it was off my radar for an age. I'm with you on that. It was like it was doing nothing. They had great assets, but they didn't do anything with it. Devin, Spur Supergroup announced their special dividend. We knew this was coming. They sold their Australian business, 16 Rand 30. Is there anything left in the rump? The question is, I'm holding. Should I take my 16 Rand 30 and exit, or is there anything left in the rump worth holding on to?
It's a good question. It's one we've been debating internally. As you said, that special dividend was telegraphed. It's great, but that's kind of fully reflected now. So what does the future look like? My sense is that we're going to look elsewhere, simply because kind of the growth prospects have kind of been diminished now, and the group is a lot smaller. It came out of its issues from COVID, but the where to from here, we're not clear on that, and so yeah, we're probably passing for now.
Yeah, and they've had existential crises before. I remember when it was Lynch, 2008-9. They almost didn't survive that. Rowan, Supergroup, with what's left of the group?
Yeah, so certainly the rump value, what's left is sort of increased substantially as the share price has recovered. So not as good value as it was, but you've got quite a clear focus on dealerships and logistics. We actually think the businesses have potential. The question mark has been over UK dealerships, which have been underperforming, and I guess some of the logistic assets in Europe, which they've pegged for sale. So I think what you had there was, to some extent, SG Fleet was the tail wagging the dog, and they're dealing with that because they obviously have sold that. Now they need to focus on those cooperations, and I think they can improve them from here. We think earnings can still grow just by virtue of turnaround and fixing some of the underperforming assets. So we still think there's value, not as much as there was. But yeah, we still holders of the Group X, the distribution.
Yeah, this was a 22 Rand share back in November before the SG Fleet announcement. It's now 30, and you're going to get 16 Rand odd for dividend. Nice. Rowan, let's stay with you a moment. Question coming through. Over the medium term, expecting a better off South African consumer, in brackets, relative, fair point. Famous Brands or Spur? Do you have a preference between the two? I mean, one is much more sort of sit-down dining, one is much more QSR. Do you have a preference between Famous Brands, Spur, either, neither, both?
Yeah, it's been a bit of a tricky space because, as the viewer pointed out, the consumer has been fairly soft, and we've seen it in the numbers. Very little top line growth, and they've sort of had to manage the margins to get some earnings growth. It is a good way to play sort of the consumer space. I'd probably say Famous Brands, just because they've got a bigger footprint and platform, a bigger store base. They've got some operations in the Middle East which haven't been performing that well, so potential for improvement there as well. But maybe some of the retailers are an easier way to play it. We like actually some of the leisure groups or the gambling groups for that sort of consumer play, discretionary consumer spend, which may grow a bit faster, and the valuations are actually more depressed.
Yeah, and we've certainly seen stunning numbers out of Sun International, re the gambling. So, Famous Brands, Spur?
I'm going Spur there. I think what you've got is a portfolio, as you said, more sit-down restaurants. We've liked it for a long time. I think where they've really been good is on the financial management, keeping the debt under control. And they're moving into smaller format restaurants now, so to kind of pick up the frequency of those visits there. So yeah, they've seem to have been able to manage crises and a softer consumer better through the past, and so on that basis as well, we're backing them.
The question which pops up every so often, I was going to say, but actually quite Sasol. So we had the Capital Markets Day, market liked it, announcement on Friday that we, and by that I mean Transnet, in other words taxpayers, are going to give them some 4 odd billion. Stock's now north of 80. Would you be looking at Sasol at this point, or is it still just like, nah, thanks?
Confession, I'm always looking at Sasol. I'm always not sure what to make out of it. It's torturous for shareholders. I think the 5 billion comes at a really good time. I think that's going to help pay down or help re-engineer the business from the emissions perspective and all of that. They still got quite a big debt pile after that, but I think it helps a lot. The business does have some merit, but they got a long way to go, and my sense is now there's a lot of retail investors involved, but kind of the institutional investors are sitting back and really waiting to see, is this thing turning around, or is it just bad money after good? So it's far from clear, but I think both those things you mentioned are a step in the right direction.
Yeah. Rowan, I mean, 4 billion is nice. Their debt, of course, is more than 100 billion, so it's scratching the surface. Your take on Sasol, certainly perhaps maybe better than it was at the beginning of the year, but not sort of out of ICU. Rowan, Sasol for you?
Yeah, I agree. It is a complex investment case, and it ultimately has been disappointing to date, so notwithstanding the short-term bounce. The management, after the Capital Markets Day, clearly have a better sort of handle on the issues, how they're going to address them, potential sort of breakup value, medium term, dealing with the feedstock issues. So it's probably worth a closer look and getting a sense of, do you believe that management can execute on their plan? Because a lot of it was significant cost savings as well. And as I guess you get increasing confidence of that, it may become sort of a more straightforward investment case. So looking at it and trying to understand, and probably monitoring and watching at this point rather than investing, but it certainly has a potential for value creation still, we believe, if they manage to get everything right in terms of execution.
Yeah, there is a lot of moving parts, but I think some of them are kind of moving in the right direction at this point. Rowan, we had a Dis-Chem update. This email actually came through over the weekend, so it was pre the update. And it says quite simply, Dis-Chem, I like the big box retailer. I like their business model. Are the valuations looking attractive? Certainly that trading update was good. The market's priced it up over 4%. Rowan, is Dis-Chem one on your shopping list?
Yeah, so we certainly like the business and the space that they're in, and they have been executing reasonably well, but there's been huge expectations in the share price since the listing, in fact. Yeah. And for a lot of the time, we felt it was sort of fully reflected or over-reflected in the valuation, the potential for the business. So a good set of numbers, and clearly on the day the market likes them. They are slightly ahead of consensus expectations. But yeah, it looks too pricey. I think just given the relative value and the other opportunities in the market in the retail or the consumer space, at significantly lower multiples, we think you can, do better, have a better margin of safety, looking elsewhere, taking nothing away from the business and then the attractiveness of the space. It's just the valuation's too high, too rich for us.
Yeah, and your earlier point around, for example, the leisure/gaming.
Look, great business, and I think the challenge we have as investors in SA Inc. is these quality counters. You think of Dis-Chem, Clicks, Capitec, they just, you struggle to get them at those attractive valuations, and the market's rewarding quality in our market when there's very little consumer growth. So, yeah, my sense is you can do worse, but the valuation is going to be a concern. But I think decent set of numbers on both the wholesale and the retail side. So, yeah, not bad.
So what do we do as an investor? Because you're right, now I'll throw ShopRite into that.
Yeah, exactly.
Partly because I remember in the depths of the pandemic it was 100 Rand, and now it's 280.
Correct.
I mean, do we wait for those 100 Rands, or do we just pay up a bit?
Look, I mean, we had the beginning of April that gave us an opportunity.
Sure.
Almost everything went on sale. So, have them on your watch list. I don't think build an entire portfolio of more dear counters, but I think there's a good argument to have some. And, yeah, they're never going to be as cheap. It's the reason I've chased Capitec and never got in for years. It just doesn't give you that opportunity. So at some stage, you've got to make a call. Will the quality endure? And then have a sufficient time period to let that play out.
Yeah, and what I also noticed, Capitec does it, ShopRite does it, large protracted periods of not doing much while valuations kind of catch up with the earnings, and then off it goes to the races again. Barloworld results are, do they matter much because they're under offer?
Short answer, no, not really. I mean, if you had to look at them, I felt they were a little bit disappointing. I think their Russian operations were a bit of a blight on those results. I think Mongolia did a little bit better, but yeah, not more academic than anything else.
Yeah, Rowan, are you looking around Barloworld, or is it really more about the delisting, which might happen or might not later this year?
Yeah, so it does create sort of a bit of a binary outcome. Either they're going to go ahead with the standby offer, or they're going to withdraw. And I guess what you'll see is either the share going up to the offer price, or I think retracing quite a bit from here, just given those recent results and the performance. So interestingly enough, sort of maybe the poor results will drive investors to sell and accept the offer. So, and maybe that's what the offeror's been waiting for. And we'll see what acceptances they get on the 30th of June to get an idea if they're going to go ahead with the deal or not. So it is an interesting situation.
Yeah, and maybe that's, and I'm not going to say that. Let's not go down that road in terms of fun and games. Rowan, let's stay with you. Let's go to stock picks. Grindrod.
Yes, so it's been a bit volatile of late. The riots in Mozambique weighed heavily on the share price, and also, I guess, did impact their volumes in the last quarter. We have seen the key commodities, coal, also soften in price, which has sort of, I guess, clouded the outlook. But we like the medium-term prospects. The Mozambique terminal is still a fantastic asset. They increased the exposure there. They're getting more involved in public-private partnerships with Transnet and in Richards Bay. So I think there's a good runway of opportunity there. And I think the outlook for bulk commodity demand is still reasonable. So they're also dealing with some of their legacy assets that may have not realized full value for the marine fuels and the land parcels, but they've monetized those, created the cash, and now they can move forward with their core business, and I think there's good growth there. So valuation also quite attractive. So overall, some of the parts, it looks appealing to us.
Yeah, and Bauer reports, chatting with Afrimat, who got Nkomati, and they go through Maputo. It seems that level of normality has returned to Mozambique. Devin, Enter Sports, if I've pronounced it half correct.
That's it. This is one of the world's biggest sportswear retailers that no one's heard of. And
me too.
It's actually the third largest manufacturer and retailer behind Nike and Adidas. And to give you an extent of the size of it, it's 23% of the Chinese sportswear market. Wow. I mean, in an emerging middle-class space, that's just massive. It's got brands like Salomon, Wilson, Fila. Those are the ones that we would know. But what they've done well is their e-commerce platform has been really good as opposed to someone like a Nike. Great margins there, and a 12,000 store footprint on the ground. So that combination works really well. No debt on the balance sheets, and to our mind, a pretty eloquent way to capture what we think is the recovery of the Chinese consumer.
Okay, and there's an enter in Morris Arch. I did not know that. We'll have to give it a look. But that's where we leave things for today. Thanks to our guests, Rowan Williams from Nitrogen Fund Managers, going with Grindrod. Devin Shutte from the Robert Group, going with Anta Sports. Up next, the close. Stay watching.